Imagine depositing your paycheck on a Friday afternoon. By Monday morning, before you've spent a single dollar of it, your bank has already put that money to work. It just isn't working for you. Most people think their money sits quietly in a vault somewhere, waiting for them to spend it. It doesn't. The moment it lands in your account, it enters a system most of us were never taught to understand, one built on a handful of quiet rules that determine who actually profits from the money passing through your hands. Here's the first one, and it's stranger than most people expect. You were probably taught that banks are required to hold a percentage of your deposits in reserve, unable to lend out more than a fraction. That rule used to exist. It doesn't anymore. Since 2020, the Federal Reserve has set that requirement to 0% for every bank in the country, not lowered it, eliminated it. Banks aren't legally required to hold back any specific portion of your deposit at all. That single fact should stop you for a second. If banks aren't held back by a reserve rule, what actually stops them from lending out everything? The honest answer is capital rules, risk models, and confidence. And confidence, as you'll see, is a far more fragile foundation than most depositors realize. But that's not the biggest secret. It's just the first crack in the story everyone assumes they already know. Think about what actually happens between the moment you deposit money and the moment you withdraw it. Your bank doesn't leave that cash sitting still. It lends versions of it out, again and again, to mortgages, to car loans, to business credit lines, each new loan creating new deposits elsewhere in the system. Economists call this the money multiplier. You could call it something simpler. Your single deposit becomes the foundation for far more lending than the original number would suggest. Here's where it gets interesting. The interest your bank pays you for the privilege of using your money is often a fraction of what it charges someone else to borrow that same money. That gap, the spread between what you're paid and what borrowers pay, is one of the oldest and most reliable profit engines in banking. It doesn't require predicting markets. It doesn't require risky bets. It just requires you leaving your paycheck sitting in a low-interest account instead of asking where else that money could go. Now here's where the story gets uncomfortable, because mortgages hide a secret of their own. Most homeowners assume their monthly payment gradually chips away evenly at what they owe. It doesn't. In the earliest years of a mortgage, the overwhelming majority of each payment goes toward interest, not principal. You could make payments for years and barely dent the actual loan balance. This isn't a conspiracy, it's simple amortization math, but almost nobody explains it clearly at the moment you're signing the paperwork, which is exactly when it would matter most. Credit cards play a similar game, just faster and more aggressive. The minimum payment on your statement isn't designed to help you pay off debt efficiently. It's calculated to keep a balance alive as long as possible, generating interest month after month. Behavioral researchers have found something almost unsettling. Cardholders who see a minimum payment listed tend to pay less overall than those who don't see one at all, simply because the number quietly anchors their sense of what's reasonable to pay. That's psychology, not accident, and it's only secret number 6. Secret number 7 completely changes everything, because it isn't about fees or interest at all. It's about something wealthy individuals have understood for decades. You don't need to sell an asset to spend its value. If you own stock or property that's grown substantially, selling it triggers taxes. Borrowing against it doesn't. Wealthy borrowers routinely take out low-interest loans backed by assets they already own, spending the borrowed cash while their original investment keeps growing untouched. Banks love this arrangement because it's incredibly low-risk lending backed by real collateral, and it's a strategy almost never explained to anyone without significant assets to begin with. Meanwhile, inflation is quietly doing something else to everyone else's money sitting in a savings account. A dollar that earns less interest than the rate of inflation isn't just standing still, it's losing purchasing power in real time, even while the number on the screen slowly climbs. Most people feel poorer without ever understanding why, because the erosion happens too slowly to notice day to day, and too significantly to ignore over a decade. Compare that to have companies like Apple or Berkshire Hathaway treat their own cash. They don't let billions sit idle in a checking account earning almost nothing. They park it in short-term instruments, treasury holdings, and interest-bearing vehicles that keep working even while the money technically stays liquid. The strategy isn't exotic. It's the same principle available to any saver willing to move money out of a low-interest account, just applied at a scale that makes the effect impossible to ignore. Hidden fees complete this side of the picture. Overdraft charges, minimum balance penalties, out-of-network ATM fees, individually small. Collectively, they represent billions of dollars in annual revenue across the banking industry, extracted from the customers who can least afford to absorb them, often the very people living closest to zero in their checking account.
But here's the part almost nobody talks about, and it's the uncomfortable truth underneath everything so far. None of this requires a single bank to do anything illegal. It's simply how the system is designed to function, quietly, in plain sight, protected by paperwork most people never read closely. Now this is where things get strange, because the entire system
runs on something you can't put in a vault: trust. In March 2023, Silicon Valley Bank collapsed in a matter of days, not because it ran out of money in some dramatic heist, but because depositors, mostly tech companies, began withdrawing funds simultaneously after concerns spread about the bank's balance sheet. The bank hadn't been reckless in any obvious criminal sense. It had simply made a bet on long-term bonds that lost value as interest rates rose, and once confidence cracked, the withdrawals accelerated faster than the bank could cover them. Credit Suisse told a similar story just weeks later, a centuries-old institution brought down not by a single catastrophic event, but by years of eroding confidence finally reaching a breaking point, ending in an emergency acquisition by UBS. What happened next shocked regulators across multiple countries, prompting a wave of new scrutiny into exactly how fragile trust in the banking system had quietly become. Both collapses reveal the same uncomfortable truth. Banks don't fail because the money physically disappears. They fail when enough people simultaneously decide they no longer believe it will be there. That's secret number 12, and it's arguably the most important one in this entire story. The banking system isn't built on cash reserves anymore. It's built on collective belief, reinforced by regulation, insurance, and decades of it simply working well enough that nobody questions it. Which brings us to the gap nobody likes discussing openly. Most people are never formally taught any of this. Not in school, not at home, not anywhere along the way. Interest rates, amortization, opportunity cost, the mechanics of lending. These aren't complicated concepts. They're simply concepts nobody prioritized teaching in a system that quietly benefits when customers don't ask too many questions. It's worth asking why that gap persists. Financial literacy isn't a difficult subject to teach. It's a subject with no obvious
institutional incentive to teach well. Schools have limited hours and competing priorities. Employers rarely explain how a 401k actually compounds beyond the enrollment paperwork. And banks, whatever their intentions, have little commercial reason to make sure every customer fully understands the mechanics working against a low-interest balance. The knowledge exists. It's simply never been anyone's job to hand it to you before you needed it. And that leads to the final, quietest secret of all: opportunity cost. Every dollar sitting idle in a low-interest account isn't neutral. It's a choice, even when it doesn't feel like one. A choice not to invest, not to pay down higher interest debt faster, not to let that same dollar start compounding somewhere else. None of this means the banking system is a conspiracy against you. Banks like JP Morgan, institutions managing trillions through firms like BlackRock, they aren't villains in a morality play. They're simply operating a business model built on spreads, fees, lending, and trust, largely unchanged in its core mechanics for generations. What changed isn't the model, it's the speed at which trust can now unravel. Silicon Valley Bank's collapse didn't take weeks, it took days, accelerated by digital banking apps and social media, where a rumor could trigger withdrawal requests faster than any teller line in history ever could. The mechanics behind banking are old. The speed at which confidence can now break is entirely new, and it's a risk regulators are still learning to manage in real time. Understanding how that model actually works doesn't make you cynical. It makes you harder to quietly profit from. If this changed the way you think about money, subscribe, because understanding the rules is often more valuable than